Welcome to this explainer. Okay, today we are diving into something really wild, the hidden, genuinely fascinating mechanics of an industry that touches literally every single one of us. We're going to track the incredible evolution of insurance seriously. How did it go from a simple, neighborly safety net into this massive, highly calculated financial engine? It's a journey that reveals exactly how an ancient idea transformed into what is arguably one of the most sophisticated business models on the planet. $250 billion. That's billion with a B. Just let that number sink in for a second. That is the staggering amount of money that State Farm alone collected in premiums in the year 2023. $250 billion taken from everyday people paying every single month for protection. They desperately hope they never ever have to actually use, but what actually happens to all that cash while it's just sitting there? I mean, while customers are waiting for a disaster, insurers definitely aren't just putting this money in a giant vault. No, they take that cash and they invest it. They pump it right into stocks, bonds, real estate, private equity. The illusion is that your premium is just a flat fee for a service. But in reality, insurance companies are using your money to make more money long before they ever have to give a single cent back. To really understand how we got here, we've got to look back at the original, honestly kind of beautiful concept of sharing risk. Think of the community risk pool. It was this simple idea where a group of people put their money together so that when one person suffered some terrible, unpredictable loss, the pool covered it. It was all about mutual community aid, but over time it evolved into a completely different beast, a profit-seeking industry. Today's insurance companies are not charities pooling risk. They are massive corporations, meticulously engineered to optimize profit and generate massive investment returns. But hey, let's give credit where it's due, right? Because those basic mechanics, you pool the money, wait for someone to suffer a loss, and then use that pool to cover their cost. That actually allowed modern economies to grow. Think about it. Without this system, you couldn't get a mortgage. Businesses just couldn't operate because the liability exposure would be way too scary by making unpredictable catastrophes manageable. This simple three-step process basically became the bedrock of modern economic life. So how do today's giant insurance companies take that foundational concept and turn it into such immense revenue? Well, the first stream is underwriting profit, and this simply means charging more in premiums than the company ever pays out in claims. To pull this off, insurers employ actuaries. These are basically math wizards who calculate your demographic risk with a precision that is frankly terrifying. They know the exact probability of you having an accident based on your age, your location, your history, and they price your premium to ensure the company expects to collect way more from you than it will ever pay out. Warren Buffett once famously called insurance the best business model ever invented, and believe me, it's not because he thinks paying out claims is fun. It's because of a hidden superpower known in the industry as the float. The float is all that premium money sitting around between when you pay the insurer and when they eventually maybe pay out a claim. It gives the company billions of dollars of other people's money to invest, and they get to use it entirely for free. Just to put the breathtaking scale of this model into perspective, $160 billion. That was the float generated by Berkshire Hathaway in 2023. Largely just from holding on to Geico customers' premiums. That is, $160 billion earning investment returns for Warren Buffett. All while the company literally just waits to see if a customer gets into a fender bender. Moving right along to Section 3, the uncomfortable math. Okay, so while the investment side is obviously super lucrative, there is a much darker side to this math, and it comes down to the combined ratio. It's simple claims paid out plus operating expenses divided by the premiums collected. Now, if an insurer wants to make an underwriting profit, they absolutely must keep this number under 100%. And since they can only hike premiums so high before people just up and leave, there is immense internal pressure to shrink the other side of the equation. And what's at the claims? Which leads directly to what you might call the science of denial, to drop that combined ratio. The incentive structure is shockingly clear. Number 1, pay fewer claims. Number 2, pay smaller amounts. And number 3, pay slower. Insurers use highly trained claims adjusters, an incredibly engineered fine print. I mean, every single exclusion and definition is crafted to find reasons to deny or reduce your payout. The goal is effectively exhausting the customer until they just throw their hands up and give up. There is a huge stark contrast between those comforting television ads we all see and the ruthless internal strategies operating behind closed doors. The industry has a very polite-sounding term for this disconnect: Loss ratio optimization sounds super technical, right? But it's literally just the strategic practice of paying out as little as possible. Major consultants like McKinsey have actually taught health insurers how to improve their loss ratios, which in practice meant teaching them how to deny claims more efficiently. It's a core strategy for the business, and there's a very real human cost to this strategy. When health insurance claims get denied, most people are simply too sick or too exhausted to fight back. But here's the kicker of those who actually do appeal. They win about 40% of the time. That means up to 12% of all denied claims actually should have been paid in the first place. It proves the system mathematically relies on customers getting frustrated and giving up. And it's definitely not just health insurance either. Follow this timeline. From 2022, Hurricane Ian hits Florida. Insurers spend months disputing claims, sending out absolute low-ball estimates, claiming damage was pre-existing, you name it, but it turned out they had severely underpriced the risk while happily collecting the float. So what happened when the bill came to several insurers simply went bankrupt, and the customers who had faithfully paid their premiums were left completely empty-handed? Let's zoom out to the macro level here because there is a massive systemic breakdown occurring right now across the country, and it's fundamentally altering this entire industry. Extreme weather is completely destroying the actuarial math. From raging wildfires in California to massive hurricanes in Florida and unpredictable floods across the Midwest, claims are absolutely skyrocketing due to climate change. The math simply no longer works. The premiums they're allowed to charge aren't enough to cover this massive influx of risk, forcing insurers to logically but brutally protect their bottom lines. So how exactly did they protect their bottom lines? Well, they pack up and leave. In 2023, giants like State Farm and Farmers Insurance just flat out stopped selling new homeowner policies in California. When private companies abandon these high-risk markets, they basically socialize the massive losses they gladly collected premiums during all those good years. But when the risk gets too high, they exit and they leave everyday taxpayers and state-backed insurers to pick up the pieces. We've essentially arrived at an unresolvable tension right at the heart of this industry. Think about it as a customer, you need a quick payout and comprehensive coverage, but the insurer, their financial model, desperately needs delayed payments and really narrow policies. And yet you can't just opt out. Car insurance is required by law. Homeowners insurance is required by your lender. You are quite literally a legally and economically captive customer, and in this required relationship, you are at a massive disadvantage. The seller holds any immense information advantage. They've got complex actuarial tables, deeply buried policy exclusions, and entire teams of professional claims adjusters. When you file a claim, you aren't just asking for help. You're playing a high-stakes financial game against experts who literally wrote the rules of the game, which leads us to the ultimate irony of our entire explainer today: the business of insurance is this incredibly lucrative, highly tuned investment vehicle that relies entirely on your money, but it fundamentally profits the most when absolutely nothing goes wrong. It works best for them when you never ever have to use it. So I want to leave you with this one final stark question to consider. In an industry that was originally built on community support, does a profit-maximizing model truly protect people in their darkest moments? Or have we somehow built a system where the business only works best when the customer suffers least, and when you suffer most, the business has already moved on? Thanks for watching this explainer. I really hope this changes how you look at that monthly premium.